April 2026. The world was standing on the edge of a total economic collapse. Missiles were flying, the Strait of Hormuz, the world's most vital oil artery, was shut down, and the smartest analysts on Wall Street were predicting $300 a barrel oil. They weren't just calling for a recession, they were calling for a Great Depression. And then the impossible happened. While the world was still on fire, the stock market didn't just survive. It had its best day in a year. The S&P 500 ripped up 2.5%. The Dow surged 1,300 points. And by the end of the month, we were at all-time highs. But today, I'm going to show you the hard data that proves the media was lying. The peace they celebrated didn't actually exist. What actually happened was much more dangerous, and it reveals that the stock market we think we know is dead. To understand the lie, you have to see how terrified Wall Street actually was. In early 2026, the US and Israel launched strikes on Iran. In retaliation, Iran choked off the Strait of Hormuz. This isn't just a minor shipping lane. If that strait stays closed, the world loses 15 million barrels of oil every single day. Commodity experts were terrified. They were warning that the system was about to creak and break. And Wall Street reacted. Hedge funds started panic selling at the fastest pace in 13 years. Short exposure to the market hit levels we haven't seen since the 2020 pandemic. Everyone, literally everyone, was betting on a crash. On April 7th, Donald Trump announced a ceasefire on Truth Social. The next morning, the markets exploded. Over 400 stocks in the S&P 500 finished green. Oil prices plummeted 16% in a single day. Peace had arrived. The narrative was set. But here is where the story gets weird. Maritime intelligence firms like Windward use AI to track GPS signals and satellite radar in real time. Their data showed that by midday, only 5 ships were moving through the Strait of Hormuz. Before the war, that number was 130. That is a 96% decrease in activity. The peace was a phantom. The ceasefire was falling apart in real time. So if there was no peace and no oil moving, why did the market go to the moon? The answer isn't optimism. The answer is a brutal mechanical phenomenon called a short squeeze. Because everyone was so bearish, they had shorted the market. They borrowed shares to sell them, betting they could buy them back cheaper later. But when that ceasefire news hit, the price ticked up just enough to trigger margin calls. Suddenly, thousands of bears were forced to buy back their shares at the same time to stop their losses. This forced buying pushed the price higher, which triggered more buying. That was domino number 1. Then domino number 2 fell, the algos. There's a group of systematic traders called CTAs. These aren't humans, they're rules-based models that don't care about news or wars, they only care about trends. Goldman Sachs reported that these algorithms were sitting on a $30 billion bet against the market. But the second the S&P crossed a specific price level, the math flipped. They didn't just stop selling, they were forced to buy $86 billion worth of stocks in just 5 days. It was one of the fastest buying sprees in history. Then came domino number 3, the options dealers. When regular investors started panic buying call options, the banks on the other side of those trades had to hedge their risk. Because of something called negative gamma, the higher the price went, the more the banks were forced to buy the underlying stocks just to stay balanced. It was a feedback loop. Squeeze, then algos, then dealer hedging. The market didn't go up because things were good. It went up because the machines were forced to buy. If this sounds like a glitch in the matrix, that's because it is. We like to think the stock market is a place where smart people analyze companies and invest for the long term. That market is dead. 20 years ago, humans ran the show. Today, 63% of all U.S. stock funds are passive. That is $13 trillion of blind money that doesn't read earnings reports or care about wars. It just buys automatically because it's programmed to. And because these funds are market cap weighted, they have to buy more of the biggest companies, which is why the Magnificent Seven now make up over 33% of the entire S&P 500. The active players that are left are giant multi-strategy hedge funds like Citadel and Millennium. They use massive leverage, sometimes 8 times their actual money. When they hit a certain loss limit, they don't sit in a room and talk about the Fed. They sell immediately, or they buy immediately based on a computer trigger. So the next time you see a headline saying markets rally on peace hopes or stocks fall on inflation fears, remember April 2026. The headlines are just stories we tell ourselves to make sense of the chaos. The truth is, the market has become a giant self-reinforcing feedback loop of algorithms, passive indexers, and options dealers all reacting to each other in real time. It's no longer about reason. It's about mechanics, and if you're still trying to play the old game, you're not just trading against the machines, you're being eaten by them. If you want to understand how the real financial system actually works, I've covered topics just like this on the channel. Check out the videos on screen right now. I think you'll find them very useful. And if this video changed how you see the markets, drop a comment below. I read every single one.